On Friday, May 23, 2026, Kevin Warsh raised his right hand in the White House and was sworn in as chairman of the Federal Reserve. The ceremony lasted minutes. What it set in motion may take a decade to fully arrive. At the moment Warsh took that oath, the United States owed $39.008 trillion in gross national debt. That number has been growing at a rate of approximately $5 billion per day, every day, while markets opened and closed, while the Iran ceasefire negotiations consumed every news cycle, while this channel published its last video. $5 billion, added to a pile that already has $39 trillion in it, and which now costs the US government over $1 trillion per year simply to service, just to pay the interest, not to pay it down, not to reduce it, just to keep the lights on. That $1 trillion interest bill exceeds what the United States spends on its military. It exceeds the entire education budget. The US is paying more to rent its own past than it spends protecting its present. And the man who now sits at the head of the institution most responsible for managing the consequences of that debt has a theory, an intellectually serious, carefully constructed, politically convenient theory about how to make that problem look considerably more manageable without a single vote being cast, a single spending cut being made, or a single tax being raised. My name is James Whitmore. Today we go through that theory, what it would mean for the US economy, and the question every other analysis of this story skips, what it means for the rest of the world that holds American debt. The theory starts with a measurement problem, or rather with a measurement choice. The Federal Reserve's preferred inflation measure is the Personal Consumption Expenditures Price Index, the core PCE. Strip out food and energy, and that number has been running at approximately 3%. 3% is the kind of reading that keeps a Fed chair's hand off the rate cut button. It says prices are still rising faster than the 2% target. It says cutting would be premature. It says wait. Warsh does not want to use that number. In his confirmation hearings, he indicated a preference for what economists call a trimmed mean inflation measure. The Dallas Federal Reserve produces one. It works like this. Take everything Americans buy, rank all the price changes from lowest to highest, cut the extremes off both ends, the items with the wildest swings in either direction, and look at what's left in the middle. The idea is that the extremes are noise. Telephone equipment crashing because of a product cycle, freight and storage costs spiking to 380% annualized because of a temporary supply disruption. These are real price changes, but they don't tell you about the general drift of the economy's price level. Strip them away, the argument goes, and you see the true underlying trend. What does that trimmed mean say? The Dallas Fed's version, approximately 2.3%. The Cleveland Fed's median measure, approximately 2.8%. Both of them meaningfully below the 3% core PCE that has been constraining Fed policy. The same economy, the same prices, the same grocery stores and fuel pumps and rents. Under one measuring stick, inflation is a problem you cannot responsibly cut rates into. Under Warsh's preferred measuring stick, inflation is close enough to target that a reasonable case for rate cuts exists. This is not a trivial distinction. The measuring stick determines what the most powerful central bank in the world does next, and what the Fed does next determines, in meaningful ways, what happens to $39 trillion. Here is the mechanism, and follow it carefully because this is the part that reaches into every saver's account without announcing itself. If Warsh uses the trimmed mean to justify rate cuts from the current Fed funds rate of 3.5 to 3.75%, the cost of the US government's short-term borrowing falls. This matters immediately because trillions of dollars in US government bonds are maturing over the next few years and must be refinanced, old debt replaced with new debt at whatever the current rate happens to be. If Warsh has cut rates, those new bonds are cheaper to issue. The fastest growing line item in the federal budget, that $1 trillion interest bill, stops climbing quite as fast. The US buys time. But buying time is only the setup. The actual mechanism that makes debt manageable at scale is older, quieter, and considerably more uncomfortable to name directly. It is called financial repression. Here is what it means. If inflation runs at 2.5% and you are holding a government bond that pays 1.5%, your real return, your inflation-adjusted return, is negative. Every year you hold that bond, you are losing purchasing power. The dollar you receive when the bond matures buys less than the dollar you lent when you bought it. The government repaid you in full in nominal terms. In real terms, in terms of what that money actually buys, it repaid you less than it borrowed. Scale that across $39 trillion, run it for a decade, and you have quietly reduced the real value of an enormous debt without a default, without a restructuring, without a political crisis. The number on the ledger stays the same. What it represents in actual purchasing power gradually diminishes. This is not theory. This is precisely how the United States reduced its debt-to-GDP ratio after World War II, when that ratio hit 106%, a level the Congressional Budget Office now projects will be exceeded by 2036, reaching 120%. The post-war strategy worked. The debt shrank relative to the economy over roughly a generation. It worked because growth was real, because the Cold War kept defense spending high and thus the economy stimulated, and because a steady, moderate inflation did the quiet arithmetic that no politician wanted to vote for explicitly. But there is a question the history books answer less comfortably. Who paid for it? The savers paid for it. The people who did the responsible thing, who kept money in cash, in savings accounts, in government bonds at the yields available, watched their real purchasing power erode year after year as inflation outran their returns. The people who owned hard assets, real estate, equities, gold, floated up with the inflation tide and came out ahead. The people who owed money at fixed rates watched their real debt burden lighten. The careful, the prudent, the diligent. They financed the government's debt reduction with their own savings, slowly, quietly, without anyone ringing a bell to announce it. This is the domestic story. There is a geopolitical story underneath it that deserves equal attention. The United States is not the only entity holding American debt. Foreign governments, central banks, and sovereign wealth funds collectively hold approximately $8 trillion in US Treasury securities. China and Japan are historically the two largest foreign holders. In return for that holding, they receive the nominal yield, currently around 4.5% on the 10-year Treasury. If Warsh's policy produces a sustained period where real inflation runs above that yield, those foreign holders are experiencing the same financial repression as American domestic savers. They lent the United States money. They are being repaid in dollars that purchase progressively less. For most of the post-war era, foreign governments accepted this arrangement because the dollar's reserve currency status, its role as the world's primary medium for international trade, commodity pricing, and foreign exchange reserves, made holding treasuries strategically rational regardless of real return. The dollar's network effects were worth the occasional negative real yield. What is worth watching is whether that calculus is changing. Since 2022, China has been steadily reducing its holdings of US Treasury securities, while simultaneously accelerating its accumulation of gold. The People's Bank of China has been one of the most aggressive buyers of gold in the world over the past 3 years. Gold has responded. It is currently trading around $4,500 an ounce at record levels. This is not purely a Chinese phenomenon. Central banks across the global south have been increasing their gold reserves. The behavior of these institutions, the people who manage national balance sheets professionally and have access to the same analysis Warsh's critics are making, suggests a directional bet. They are reducing exposure to an asset that could be inflated away and increasing exposure to an asset that cannot be. If the Warsh framework produces what its logic implies, moderate but persistent inflation, negative real yields on treasuries, a gradual erosion of the dollar's purchasing power, then the foreign holders of US debt are not passive victims of this strategy. They are watching it unfold, adjusting, and the adjustments they are making tell you something about what they expect. There is a significant complication in the mechanism that Warsh's strategy requires, and it is worth naming directly. Warsh wants to cut short-term rates while simultaneously shrinking the Fed's $6.5 trillion balance sheet, the bonds and mortgage-backed securities accumulated during years of quantitative easing. The theory is that tighter balance sheet policy counterbalances the inflationary pressure of rate cuts, reduce the money supply on one dimension while reducing borrowing costs on another. The bond market has a view on this combination. When investors anticipate a Fed chair comfortable with letting inflation run hotter than the headline number suggests, they do not lend at low long-term rates. They demand a premium. They price in the inflation they see coming. This is visible in the current data. The 10-year Treasury yield sits at approximately 4.5%. The 30-year yield has spiked above 5%. 30-year mortgage rates are hovering around 6.5 to 6.65%, rising, not falling, even as rate cut expectations grow. This is what bond traders call a bear steepener, the Fed pushing short-term rates down while the long end rises, driven by inflation expectations that investors don't trust the new chairman to suppress. The consequence is a specific irony. The strategy designed to reduce the government's borrowing costs works at the short end. The federal government refinances its short-term debt more cheaply. But at the long end, where mortgages are priced, where businesses borrowed for capital investment, where pension funds construct their portfolios, rates are rising because the bond market is pricing in the very inflation that is quietly dissolving the national debt. The same force that helps the Treasury punishes the homebuyer. These are not separate effects. They are the same mechanism seen from different positions. None of this requires dishonesty on Warsh's part. The tringed mean is a legitimate economic concept with serious academic support. The post-World War II financial repression precedent is real, and it worked. The argument that temporary supply shocks, an Iran war driving oil prices to $100 per barrel, as we have spent the last several months covering, should not be treated identically to demand-driven monetary inflation is defensible. Warsh may be correct that the underlying inflation trend is closer to 2.3% than 3%, but correct and convenient are not mutually exclusive. A framework that happens to justify exactly what the White House has been demanding, lower rates, looser conditions, and that happens to make the government's debt position more sustainable, while asking savers to accept below-inflation returns as the cost of the arrangement, is a framework that serves some interests considerably better than others. The question to ask of any monetary policy framework is not whether it is intellectually coherent. Most of them are. The question is who benefits, who pays, and whether the people paying ever got a vote on the matter. In the case of financial repression, the answer is consistent across history. The government benefits, the borrower benefits, the owner of hard assets benefits, the saver finances it all. And the saver does not vote on monetary policy. As of Friday, May 23, 2026, the man who will make these choices for the next several years has taken his oath. The $39 trillion sits on the ledger exactly where it was. What changes is the framework through which it will be managed, quietly, gradually, over years, in the only way large sovereign debts have ever actually been resolved without catastrophe. Whether you are among those who benefit from that resolution, or among those who pay for it, depends almost entirely on what you own and what you owe. That is the question Warsh's appointment puts on the table. It will not be answered by headlines. It will be answered by what happens to real purchasing power over the next decade. This is James Whitmore. I'll see you in the next one.